Good afternoon, everyone. Welcome to this weekly update for global markets for the 10th of August. And the question I pose today, particularly after Friday night's big reversal in America, is has the correction finished? Have we had another dip, brief and short dip in America, and the market is going to head off again? I'm not so sure this time, but we'll know in a week or two. So let's have a look at the action for last week. The S&P index, amazingly, after the big sell-off on Wednesday and Thursday, amazingly managed to gain 6 points on the week thanks to a big reversal on Friday night. There was a big increase in volatility, and that was due to obviously what's going on with Russia and Ukraine, and also with what's happening in Iraq. There was a huge market reaction from Obama's announcement that there would be airstrikes against the insurgents in Iraq. And typically, as happens a lot of times, the threat of military action sees the market sell off, and then once the military action starts, then quite often the market will, that'll be the low point of the market. We saw it in 1991 with Desert Storm, and it's happened several times since then. So it's possible that the American market has bottomed out. It certainly got down into the support zone that I'd identified last week. It was a pretty obvious one between 1900 and 1920. The price got down to 1910, exactly right in the middle. So that support area has held so far. What I like to see, what gives me the most confidence, is during a correction when you get a final big day of selling, you get a big dramatic down candle, and you get quite a lot of increase in volume, and particularly volume on the sell side. We haven't seen that yet, but then again, we haven't seen that for nearly 2 years, so it won't necessarily happen again this time either. But certainly if we did get a bit of capitulation selling, then I would then be extremely confident about wading back into the American market. But irrespective of whether there is a bit more downside to come over the next few weeks, or whether we've basically seen it already, the buying support is strong. The rebound on Friday night was very, very impressive. So no one really knows what will happen in the very short term, in the next few days or next week or so, but certainly the buying support is there. The economics in America are robust enough, the corporate profits are robust enough, and the valuations, despite what you read and hear, there are some overvalued stocks in America. They are very much in the minority. There's a lot of stocks that are terrific high growth stocks that are extremely cheap, far, far cheaper than their equivalent counterparts in Australia. So there still is a very, very good case for continued trading and investing in America. Let's just have a look at the American market. I'll get queued up. So we'll start with the S&P, and you can see this little green bar here is the area that I nominated as likely support for a number of reasons. It was Fibonacci support levels, it was the support of the 150-day moving average, which quite often is a key in that. It was also these prior peaks that met resistance around about 1900 that occurred in April and again in May. So there was a number of things all coming together in this region. It was also oversold, and so we got a big bounce, and that basically erased all the losses from Tuesday, Wednesday and Thursday. So pretty impressive in America. Now that was at the S&P. Interestingly, the NASDAQ index for the techs didn't rebound nearly as strongly. So that's really quite interesting, and that's another reason that leads me to believe that this time maybe we might get a bit more selling, because normally the NASDAQ will tend to lead in the downwards direction and also in the upwards direction. For the S&P to outperform suggests to me that there might have been just some support coming in for some of the major stocks, and that the NASDAQ really hasn't rebounded yet. So let's just go back and look quickly at the S&P. So I guess the other potential, what we don't know yet, is whether we are going to get a completion of an ABC correction, which is what normally happens. We haven't seen too much of that of late, so we get the first leg down is our A leg, then the B leg is a bit of a bounce. It should be fairly weak and shallow, and then we get a final washout to complete the pattern. Now, we haven't seen that for some time. As you can see back through here in September 2013, we didn't get that. We just went straight down and straight back up again. Coming over to January of this year, straight down, straight back up. We got a very minor little bounce, but not really. We saw it perhaps a little bit in April. We had 2 or 3 days down, we had 2 days up, and then 2 days down. So it would be very instructive to see. But either way, whether this is the bottom or whether we'll get a bit more downside, the US is certainly a terrific place to be buying. That's for sure. Looking at the Aussie stocks, our index lost 147 points for the week with an absolute smashing on Thursday and Friday. This was a very, very sharp reversal. We had a sharp reversal the previous Friday, and I said last weekend that it was quite likely that our market would follow through because of that reversal, and it did. It followed through in a major way. And it was really, a lot of it was due to the banks. The banks got absolutely slammed. BHP and Rio did better. Rio came out with some very solid results. So the banks, there's definitely a sector rotation going on. Money is finally coming out of the banks. We'll have a look at that index in just a minute. So I'm still expecting in the Australian market that August and possibly September is going to be more of a weaker to sideways action. So you want to be careful in Australia and just be aware that it looks very much like there is a bigger picture rotation of money out of banks and into other sectors. Let's have a look at the Australian market. We'll start with materials index. So you can see materials were down on the week, but only fairly mildly so. Let's look at banks. Banks down hugely. Now, we'll probably get a bit of a bounce from here because they're close to oversold. They're also close to this moving average. But you can see that the last time we got a big ABC correction in banks, which basically started in November of 2013 and really completed in February. So it took around about 3 months. So here's our A leg. Took us down below the 150, and that's probably where we're at now. We're still in the A leg. We then got quite a decent sized bounce, but you can see that after 3 or 4 strong days up, it really started to peter out very quickly, and then we got the completion of the C leg to the downside. I think given the sharpness of this sell-off, I think it's highly likely we're going to see something similar. So I would really expect to see our banks perhaps duplicate something that looks like this. And if there really is a bigger picture sector rotation out of banks, then it may even go a little bit deeper. So I'd be very, very cautious on buying the dips on banks just for the time being. I think that will be a good thing to do, but perhaps after we've had a second burst of sell-off, which may not occur until September. So keep that one in mind. Turning to commodities, gold rose $15 for the week with all of the turmoil overseas. It was a better period for gold. So it basically erased the previous week's decline. We were down $14 last week, the previous week, up 15 this week. And gold stocks rose with gold, so they're still doing as well, if not better, than precious metals itself. Silver copper belting on Thursday, I'm not quite sure what that was about, and so over the week did significantly worse. Now, copper is slightly to $3.18, just down a couple of cents, and crude oil was steady at around 98. Let's take a look at those charts. First of all, we'll look at a weekly chart for gold. So you can see not a lot of movement, and we're still stuck in the middle of this phase 1 base. Very frustrating. but eventually it's going to move one way or the other, and I think that way will be to the upside. Just looking on the daily chart, you can see quite a nice rebound on Wednesday and Thursday, and actually shot up on Friday as well. But after some of the tensions around Ukraine eased off a bit, then gold came back a little as well. This is silver. We had a fairly sharp sell-off on Tuesday, so silver down on the week. And if we look at gold stocks themselves, the gold stock indices, this is the GDX index. Again, still in the middle of its phase one, but much more towards the top of it. GDX, similar. So not a lot of change in gold stocks. There's the spot copper chart, so it really is unchanged now for quite a period of time, and similarly with nickel. So if anyone is trading any of the nickel stocks, then we've had a 50% rise through to about May in the price of nickel, and it's been pretty stable since then. So just taking an overall look, I'm still expecting that we're going to get a month or two of softer markets. This is just a normal mid-year slowdown, happens nearly every year. People trot out certain triggers for it, but the bottom line is that markets needed a bit of a breather, and these triggers were as good as any. It's still a time for caution. It's very much a time for positioning. It's a bit like a chess game. You need to be thinking a few moves ahead, and I would be not doing too much in the market until we see whether we are going to get a further burst of selling. So the US market may have bottomed. I'm not sure. There's some other indicators that aren't really clicking into place yet. Markets are nervous. There's still plenty of triggers out there with what's happening in Iraq, what's happening around the Ukraine. So I would just be cautious for the time being. For anyone that wants more information about how I might be able to assist them in the Australian market, or indeed in the American market, which is very, very exciting, there's my contact details for any non-members. Would love to hear from you. That's it for this week. Cheers.